Why hitting the debt ceiling would be catastrophic for U.S. economy. The United States government is currently approaching a critical point, the X date, at which it could potentially default on its financial obligations. This situation is known as breaching the debt ceiling, and it could have significant and severe consequences for the U.S. economy. Even the mere potential for a default could cause disruptions to financial markets, while an actual breach could lead to the loss of millions of jobs and a decline in the economy. The current administration has achieved historic economic gains, including robust consumer spending and low unemployment, but these could be rapidly reversed if the U.S. government defaults on its obligations. This video will explore why hitting the debt ceiling would be catastrophic for the U.S. economy. It will examine the role of the debt ceiling, the risks associated with breaching it, and the potential consequences of a default. The article will also consider the arguments for and against raising the debt ceiling, as well as the political and economic implications of this decision. What is the debt ceiling? Congress created the debt limit, or ceiling, in 1917, to set the maximum amount of outstanding federal debt the U.S. government can incur. The purpose of the debt ceiling is to limit the amount of debt that the U.S. government can incur, and to encourage Congress to control federal spending. The debt ceiling is not a limit on spending, but a limit on borrowing. It does not affect the government's ability to spend money that it already has, but it does limit its ability to finance new spending by borrowing money. The current debt ceiling is $28.4 trillion, and the U.S. government has already reached this limit. However, the government is currently using extraordinary measures to manage cash flow and prevent a default. These measures include suspending investments in certain federal employee retirement funds and drawing down the Treasury's cash balance. These measures are only temporary and cannot be used indefinitely. The Treasury Department has warned that a default could occur as early as June 1st if Congress does not act to raise, suspend, or eliminate the debt limit. What are the risks associated with breaching the debt ceiling? Breaching the debt ceiling would have severe consequences for the U.S. economy and financial system. The risks associated with a breach of the debt ceiling include: what are the potential consequences of default? A default would have severe consequences for the U.S. economy and global financial system. The potential consequences of default include: should Congress raise the debt ceiling? The decision to raise the debt ceiling is a contentious issue, with arguments for and against the move. Those who support raising the debt ceiling argue that it is necessary to prevent a default and to ensure that the U.S. government can fulfill its financial obligations. They argue that failure to raise the debt ceiling could lead to a catastrophic economic crisis, with job losses and a decline in the economy. They also argue that the debt ceiling is an artificial limit that does not reflect the reality of the U.S. economy, and that it is necessary to maintain the full faith and credit of the U.S. government. Those who oppose raising the debt ceiling argue that it is necessary to control federal spending and to prevent the government from becoming too indebted. They argue that raising the debt ceiling would only encourage more government spending and that it is necessary to maintain fiscal discipline. They also argue that the debt ceiling is a useful tool to encourage Congress to control federal spending and to prevent the government from becoming too indebted. Conclusion. In conclusion, hitting the debt ceiling would be catastrophic for the U.S. economy. The risks associated with breaching the debt ceiling include market disruptions, job losses, and economic decline. The potential consequences of default include recession, chaos in financial markets, and lasting damage to U.S. leadership in the global economy. The decision to raise the debt ceiling is a contentious issue, with arguments for and against the move. However, economic experts warn that default would have catastrophic consequences, including widespread job loss and a stock market fall. It is essential that Congress acts to raise, suspend, or eliminate the debt limit to prevent a catastrophic economic crisis. Lasting damage to U.S. leadership. A default could cause lasting damage to U.S. leadership in the global economy, with other countries losing confidence in the U.S. economy and reducing their holdings of U.S. Treasury bonds. Stock market fall. A default could cause a significant drop in the stock market, with investors losing confidence in the U.S. economy and selling off stocks. Widespread job loss. Even a brief default could lead to a crisis with spiking interest rates, plunging equity prices, and shutdown of short-term funding markets, resulting in nearly 2 million lost jobs. Chaos in financial markets. A default could lead to chaos in financial markets, with investors losing confidence in the U.S. economy and selling off Treasury bonds. This could lead to higher interest rates, which would increase the cost of borrowing for the U.S. government, as well as for businesses and consumers. Recession. A default could cause a recession in the U.S. economy, with job losses and a decline in economic growth. Global financial system. A default would not only affect the U.S. economy but also have global implications. The U.S. dollar is the world's reserve currency, and a default could lead to chaos in financial markets worldwide. Other countries could lose confidence in the U.S. economy and reduce their holdings of U.S. Treasury bonds. This could lead to a global financial crisis. Economic decline. The historic economic gains achieved under the current administration, including low unemployment and robust consumer spending, could be rapidly reversed if the government defaulted on its obligations. A default could cause a recession, and the U.S. could face lasting damage to its leadership in the global economy. Job losses. An actual breach of the debt ceiling could lead to severe damage to the economy, with job losses numbering in the millions. According to Moody's, even a brief default could lead to a crisis with spiking interest rates, plunging equity prices, and shutdown of short-term funding markets, resulting in nearly 2 million lost jobs and a decline in real GDP. Market disruptions. Even the potential for a breach of the debt ceiling could cause significant disruptions to financial markets. The US dollar could weaken, and investors could lose confidence in the US economy, leading to a sell-off of US Treasury bonds. This could lead to higher interest rates, which would increase the cost of borrowing for the US government, as well as for businesses and consumers.